Well, it's already been an intriguing start to the year, with a soft landing in the United States looking increasingly likely amid a stronger than expected jobs report last Friday for the second month in a row, sparking a bit of a sell-off in Treasuries, led by the belly of the curve and helped along by some more hawkish than expected minutes from the December Fed meeting. And that move higher in yields, allowing the dollar to rebound in what was the dollar index's best week since early July, while equities have kicked off the year in rather sour fashion, with the S&P 500 notching its first weekly decline last week since all the way back in October. Another busy week awaits this week. Inflation, Treasury auctions, and the start of fourth quarter earnings season, the highlights, which leaves us with a busy show to get 2024 underway on the Trade-Off UK. So without further ado, let's roll the titles and get into things. Well, it's already a strong start to the year on the show, given it took us 2 takes to get the intro done, and I got the year wrong in the first one. So let's bring in a man who is by far and away more alert and awake than I am. My good friend, as always, joining me for a new year on the Trade-Off, Ryan Littlestone from Forexflow Live of Forex Analytics. Ryan, a belated Merry Christmas and Happy New Year to you. I won't repeat what Kyriakos said about you potentially having eaten too much over the festive period, but I hope you had an enjoyable time nonetheless.
Yes, Happy New Year to you guys as well. And I know you said it took us 2 takes. No, it took you 2 takes to get it right at the start. So don't blame the rest of us for your mistakes, mate. But yeah, Happy New Year, and glad to be back and ready to get ripping into 2024.
Yes, I'm glad you emphasised the 4 on that one. It was sort of the royal us. I like to think of it as a team effort on this show, you know, one for all and all for one and all the rest of it. But yeah, back in the saddle, and it was an interesting week last week. Plenty to get our teeth into, isn't there?
Yeah, very much so. And it's going to be a volatile year, I think. It started off a bit quiet, but I think it's going to start spicing up very soon.
Yes, absolutely. It only took a couple of days for things to get going properly, and long may that continue. So let's get into topical thunder and digest some of the big themes from the last 4 or 5 days. So I want to kick things off with a look at the December US labour market report. Obviously, the highlights from a data point of view, at least, of the first trading week of the year. And for the second month running, headline non-farm payrolls coming in above expectations, rising 216,000 to round out a 2023, which was very positive and surprisingly resilient for the US labour market, that above the consensus of 175,000 and well above both mine and Ryan's own guesses in the Forex Analytics payrolls sweepstake. Other parts of the jobs report were similarly positive. Unemployment holding at 3.7%, consolidating that move lower that we saw in the month of November and just above the cycle lows. Average hourly earnings also ticking higher by 0.4% on a monthly basis. That is, again, unchanged from the pace that we saw in the month of November. A little bit of an increase on a year-on-year basis, 4.1 up from 3.9, although there's a little bit of a base effect coming in there. And actually, I don't think these figures are going to be of too much concern for the Fed. I think the risks of a wage price spiral are pretty low at this point. But what the average hourly earnings figure does speak to is that in certain sectors, at the very least, there is still a scarcity of labour and a bit of a supply-demand imbalance, which I think that the Fed will look to be equaled out and bring into a better balance as the year progresses. I think the only real blot on what was a very, very strong and solid copybook in terms of the jobs report was the participation rate. That coming down from 62.8 to 62.5% in the month of December. I wonder whether there might be a little bit of a festive impact in there, people stopping their job hunts over the Christmas period. So it's going to be very interesting in the first couple of months of 2024, whether that continues and whether we do see participation begin to trend lower. But overall, it is a very, very resilient labour market report. You've still got initial jobless claims holding around 200,000 as well. They're very close to their cycle lows. And unsurprisingly, the market having a bit of a hawkish reaction to that and some of the other data we got out of the US last week, all very positive, besides the ISM services data, which I would argue is a bit of an outlier given the totality of the other reports that we've got. So the market has repriced in a hawkish direction while we've been away over the last couple of weeks. 25 basis point cut from the Fed in March is now about a 66% chance, which is the lowest pricing since Powell's perceived dovish pivot back at the December meeting. It was a 50-50 chance, a coin flip, after the payrolls number on Friday afternoon. And we now see about 130 basis points worth of cuts priced over the course of this year, which is 30 basis points less than where we were at the end of last year. So I guess the question, Ryan, is, the market's already starting to gyrate in terms of rate cut pricing. How do you see this evolving in the weeks and months ahead?
Yeah, very much so. It was very interesting. We needed to really get to Friday to see what the true market reaction was going to be. And we saw both ends of the scale there. We obviously decent numbers on the NFP, saw dollar rally, yield pushing up a bit. Then we got that services ISM, which I think is a bit worse than, I don't think it's easy to brush under the carpet, that one, because December should have been a strong services month, particularly in the hospitality retail side of things. Then we saw, market going the other way, and it told me that the market really is trying to, it's going to sell the dollar harder on bad news than it is going to buy the dollar on good news. That's a key thing I took from watching the market over both those numbers. But as you say, we are having a bit of a reprice of that extreme pricing or expectations for Fed cuts, 150, 160 basis points when the Fed are looking at 3 cuts. There's a big disparity there, and we knew we were going to be trading between that at some point this year. So, yeah, while the market is ready to sell bad news and hit it quite hard, there's other sides of the market saying, okay, well, you've priced enough as far as Fed cuts go, so we're not going to let you run too far with the sells now. So we're finding a bit more of a balanced market. And as you see from the prices coming in this morning, we're pretty much banging the ranges in the middle of that daily range for Friday today. So, yeah, it's an interesting opening few punches, shall we say, for the new year, just to see how the market's going to react to data. I did think the bond market wasn't quite back to full functioning last week. That's going to be the case from this week onwards. So, yeah, there's lots to watch still in these early parts of the new year, just to see what the market wants to do and how it wants to set up. For the moment, as far as Fed cuts go in the broader market, I think things are finally balanced.
Definitely, and I think that's important to remember. People are still coming back. I can avoid knocking my microphone over. People are still coming back to their desks from the holiday period and getting back up to swing with things. The other thing you've got to recall in terms of Treasuries is there was a really heavy slate of corporate issuance last week, which the market had to absorb. So obviously that would have had a bit of added a bit of selling pressure to the market. Just lastly on this, the reason why I'm a little bit cautious to read too much into the ISM services print is just because we saw exactly the same thing this time last year, where we had a massive fall in the ISM services PMI in December. This year, I think it was 3 index points. Last year, it was 5. And then it was pretty much all given up, retraced in the January reading. So I'm just starting to wonder whether there might be a little bit of a quirk in terms of the ISM methodology or the survey responses, which is causing that December number to be distorted, particularly because it seems a bit out of whack with some of the other data that we've been getting. But if we need to look closely at things like retail sales, industrial production, all that kind of stuff, just to gauge a better understanding of the economy and how it's evolving as the month progresses. But it's also somewhat at odds with the S&P Global PMI. So, perhaps a note of caution is required with that. But we could talk about PMIs until the cows come home. We're not going to, because you want to talk about one of our favourite subjects, don't you?
Yeah, going to talk about the UK. And at the moment, there seems to be a bit of a shine to the UK, particularly from investors coming into 2024. There's a few banks who see better economics, and the data is holding up well enough. While we get things like manufacturing PMIs still in the doldrums, the manufacturing sector really looking quite soft. Services actually improved quite well on the flash number when we got the finals last week, and the underlying details of that were largely positive as well. We know that retail sales were strong in November. I was worried maybe they're going to fall off a bit December, but there's every chance that they're fairly good in December too, given the comments we've heard from many of the supermarkets. Does indicate that there's perhaps a bit of switch out between present shopping and food shopping into the Christmas period, but still looks like there's been some fairly strong growth there as well. on the election front, which we know is happening this year, the stable doors have really opened early. I wasn't expecting us to start getting some election stuff till maybe the end of Q1, beginning of Q2, but literally from the get-go, we've had pretty much nearly all the main parties launching their campaigns in one way or another last week. And all that culminated in PM Sunak coming out and pretty much ruling out a spring election. So we still don't have a date, but the early part of the year, it looks to be ruled out. Looks like it's going to be in the second half of the year sometime, maybe towards the end of the year. So a lot of this growing positive sentiment has meant that the pound has been a bit more supportive lately. It's more a dip buy than a rally sell at the moment. But as we know from experience, the good news needs to keep holding up or the tables will turn bearish once again. For me, the risk right now is that the quid might remain supportive on the back of the late year data that we're going to get over the next few weeks. But that data, as I say, will need to hold up when we start getting the new year numbers. If those don't, the positive sentiment will probably evaporate really quickly and the UK will once again get bashed with the ugly stick. And that means for trading the pound, if you're bullish right now, that's fine. It's fine to ride this wave of positivity, the better sentiment, but don't hang on to that view if the data turns.
Yes, absolutely. I think being nimble and agile is the key. Well, it was certainly the key for markets in 2023. I think it's going to be the key in 2024 as well, and certainly for something where sentiment can be as flippant as it has been with sterling over the last, pretty much last decade at this point. We're talking a couple of things I will pick up on. I think there has been, just anecdotally, it does feel as if sentiment has improved in the UK. So pretty much since Christmas almost. Some of the doom and gloom has lifted. As you said, the PMIs came in with a nice upgrade compared to the flash estimates. Mortgage rates are starting to come lower in a pretty significant way, actually. You're now seeing 5-year fixes under 4%. They're becoming increasingly common. So that is obviously going to help household budgets, although a lot of remortgaging obviously took place last year. I think there are still concerns over how spending is going to evolve in January. I was talking to a few business owners in the city last week, and they were saying that trade had been a little bit slower than they've been expecting. So perhaps a note of caution there. And then, of course, you've got the election. I don't think the market's going to pay particularly much attention to that just now. The 14th of November is the date that has been rumoured and that the Westminster bubble seems to be running with at the moment in terms of the election being called here in the UK for mid-November. The chief economist over at UBS, a guy called Paul Donovan, he used the words interminably tedious to describe the Brexit process when that was going on for 6 or 7 years. I'm going to steal that phrase and use it to describe the election, because that is exactly what the campaign is going to be over the next 11 months. It is going to get very, very boring very, very quickly, if it hasn't already. And I don't think markets are going to take particularly much notice of any of it until we get some meat on the bones of what may happen from a fiscal point of view. But then the opinion polls have Labour so far ahead that you would actually say a Labour victory is probably discounted at this point. But obviously that's a story for the back end of the year. For now, it does seem, for once, and it is a rarity, that everyone's getting a bit more bullish on Blighty, which is great to see. Yeah,
and it's we may even see you getting a bit bullish on Blighty, your own country at some point. But
we've got to get ahead of ourselves, mate. It's week one. It's not peak too soon.
51 more weeks to go. So, let's not peak too early, eh?
Exactly that. There's plenty more room for pessimism, that's for sure. Right. Let's get on to inflation. Obviously, we had the fun of the fair with the payrolls number last week, but focus turns to the latest price data out of the US this week. We obviously had inflation out of the Eurozone last week. We get the December CPI figure from the US on Thursday, and then we get the PPI data on Friday. Expecting a modest uptick in the headline CPI gauge this week, up to 3.2 from 3.1% previously. I think that's not particularly concerning, given that it is largely driven by the base effects and largely driven by energy coming through from last year, as we saw in all the data out of Europe last week. More importantly, for markets and for policymakers, the core inflation gauge should come down to 3.8 from 4% on an annual basis. So continued disinflation when you strip out those volatile food and energy components. So I think that is really what markets and what policymakers are going to be focusing on. And this is something that I know we said throughout 2023, throughout last year, but I think it's worth repeating, and that is that while markets are pricing in quite an aggressive pace of rate cuts, it's still important to recall that we're talking about inflation that is significantly above target. I mean, you look at that core CPI number, it's still double where the Fed would want it to be in an ideal world. And I think unless and until we get inflation back down closer to that 2% target, not necessarily there, but a couple of percentage points, a couple of tenths of a percentage point above, I should say, at the very most, I think it's going to be unlikely that we start to see those cuts actually seriously make their way into the policy-making conversation. And of course, in the United States, you do have perhaps something of a political angle as well. With this being a presidential election year, everyone on all sides of the political debate is going to be looking to try and politicize Fed policy if they can. So I think at the margin, that may actually lead to policymakers waiting until inflation is a little bit lower and a little bit closer to 2% than they otherwise would. But as you said, Brian, the market does, it appears at the moment, have more of an inclination to sell the dollar on bad data, or on a cooler number, than it does to buy the dollar on strong data. So I thought I'd pull out this stat for you, and that is that the dollar index, which is an okay but arguably useless proxy, has been lower after the CPI number on 8 of the last 10 occasions in the half an hour following the print. And the most interesting thing about that is the direction of the surprise compared to consensus doesn't affect that figure at all.
Oh, there you go. There's a first great stat of the new year. I'm going to keep a close eye on that one when we get that data out. And if it's wrong, I'll pick it up on that next week, on next week's show. But,
I'm sure you will.
Yeah, get my pen and paper ready. Right, but yeah, I've been thinking about this and inflation coming into this year. And I think the big issue, the market's obviously heavily pricing cuts. The Fed themselves are saying that the next move is likely to be a cut. What happens if inflation doesn't continue dropping? What happens if headline inflation sticks around this let's call it 3 to 3.5% mark for the next 3 to 4 months, and the core still remains sticky? What's that going to do for these rate expectations? Is it going to twist them more hawkish for the market, thinking that the Fed's going to have to hike again, or will it just become a more higher for longer, and the Fed having to sit with higher rates for longer? And I think that's a big question that we're not really talking about. Not the fact that they might hike again, if they have to leave rates where they are for a significant amount of time, because that's going to sort of eventually start really eroding into the economy, having those rates that high. So as much as we may be seeing inflation come back down, and if it continues, we're all well and good, then we know that cuts are the likely outcome. But if we get it, through the first quarter of this year, and inflation hasn't come, let's say we're not seeing a two-hander on any of these numbers, then the market's going to start having to think about what the Fed needs to do, and the Fed are going to have to think about what they need to do as well. So we're not at the end of this inflation story by any means, one way or another. So I think it's definitely going to be interesting these first few months.
Yes, completely agree. The Fed actually made mention of that in their minutes, didn't they? They were talking about the need to perhaps maintain a higher policy rate and a tighter policy stance for longer than market participants are currently expecting. I think we're still in a conversation around duration rather than level of rates, as we were pretty much throughout the second half of the year. It's a question of how much longer do we stay at terminal, and when does the first cut come, not do the Fed hike again. There's only one man out there that I know thinks the Fed might hike again, and that is Mr. Richard Matthews. And I am a very, very good friend of Dick's, but I think on this one he is almost certain going to be wrong.
Yeah, it's all right for the Fed to say, yeah, we're happy to keep rates higher for longer, but then how much longer is longer? If they've still got
a piece of string.
If they've still got rates up above 5%, in 6 months' time, then, as I say, what damage is that going to be doing the economy? And then they're going to be thinking, well, we need to get rates down if the economy is starting to crater. But if inflation remains where it is, we've got that side of the coin. So there's a timeline problem for the Fed. Higher for longer now, the message, absolutely fine. 6 months' time, that longer is going to start to test the market, I think.
Very much so. We will see how that evolves. It's interesting. We're talking about inflation being too high, but of course, there is one very, very large economy where inflation is too low.
Yeah, and that economy is China at the moment, and that's another country to keep your eye on the early part of this year. We get inflation data from those guys as well on Friday, and it's forecast to be another negative number, negative 0.4% year on year. That would make it 3 on the bounce for negative numbers, and officials over there have told us they're not going to be heading into deflation. Well, 3 negative numbers on the bounce suggests otherwise. That's going to further increase the market's worry that we are entering a deflationary phase and increase expectations that they will ease policy further. Now, with the US and others still looking to move away from their reliance on Chinese products, this will put a lot of pressure on China's trade early and maybe force them to start sounding a bit more conciliatory in certain areas. They've already said they want to increase flights between the US and China. They're loosening trade tariffs with Australia. So more of those sort of headlines will look like they're trying to ease tensions in the view to maybe stoking demand for their products. Now, the performance of China still has big ramifications for lots of markets. So their early year economic performance could be a bit of a trendsetter for some assets for the rest of the year. I think Aussie dollar as one of those. My main focus will be on what they do with their currency, as they're still likely to be very active in directing it this year. Also, we need to look at commodities as well. We know there's a bit of a manufacturing slump. If that picks up further in China, that's going to put pressure on oil markets as well and other commodities. So there's a lot of things to happen with this country early this year, and it's could be a big driver for some of the other assets as well.
Yes, very much so. I was having a conversation about China with Mr. Weston this morning, and well, I can't repeat the exact language that we used on that conversation, but let's say we weren't particularly optimistic about where the economy is likely to head over the course of this year. It is a little bit laughable that you've got officials there going, well, we're not going to go into deflation. I mean, look at your own data. The data that you make up, quite literally, proves that you are going into a deflationary spiral. And I think this is a real risk. And, you rightly say that it does have a read through into other markets. I think commodities is a big one. 2023, I don't want to spend too much time looking back, but was a grim year for commodities. You look at things like copper, crude, pretty much any industrial commodity ended the year lower and quite sharply lower. And unless we do see a big pickup in demand, and most of that pickup would have to come from China, then it looks like another relatively torrid time could lie ahead there as well. But I do think, from a market point of view at least, the story for Chinese equities and by extension Hong Kong equities as well is still one of stimulus. The market still has this hope that there is going to be some sort of shock and awe bazooka style stimulus from a fiscal level coming from China to try and ride to the rescue and solve this myriad of problems that they're currently dealing with. As time goes on, it just looks like that isn't going to be the approach that the authorities over there take. It seems to be a much slower and a much steadier approach in terms of actually bringing stimulus to the table. And I do wonder, unless the market either dramatically reassesses its expectations or policymakers dramatically shift their approach, I do struggle to see a bull case there. And I've said that just as I noticed you're drinking out of a cup with a bull on it.
It's actually an elephant. So,
is it? Oh, yeah. Sorry, that's my.
I don't know what that means in market terms, but you can make that one up. But yeah, I think you're right. I think if we do see this CPI number coming in maybe worse than expected, I think that's going to be. It's not going to be long before they start to cut rates again, and we've got to look at things like the big RRR cuts as well, and see if they're going to just do piecemeal cuts like they have been, or whether they're going to do something a bit deeper, and that's obviously going to have a big impact on the one end, as I said, currencies like the Australian dollar.
Absolutely. And you got a whole bunch of trade data out of China on Friday as well. The CPI is for November, I think. The trade data is for December, so just bear that in mind. But obviously the trade data is key, particularly when you start to think about the Eurozone. Germany's economy is incredibly, the outlook there looks incredibly dire at the moment, and a pickup in Chinese demand is really needed both there, but also in terms of Europe more broadly. You think about the luxury goods sector, for example. They really, really do need China to start turning things around before some of these names. You think about LVMH, a lot of the French companies and the French economy, they do need a bit of a turnaround in China to see their own fortunes turn around. So a very, very important story to watch as we move throughout 2024. But why don't we have a look at some charts? I'd forgotten while we've been away how uncomfortable this chair is. That's why I keep fidgeting around here. I need to get a Pepperstone, get me a cushion or something like that. Right, let's have a look at some charts. I'm going to start. It'd be rude not to start without a look at Ryan's favourite chart, and that is, of course, the S&P 500. There we go. He rolls his eyes as he always does, but he loves it really. Right, we obviously snapped a 9-week winning streak last week. The S&P 500 notching its first weekly decline since last October. Higher yields, bit of a hawkish repricing, a stronger dollar, and of course that Santa rally, that favourable seasonality into the Christmas period starting to fade and reverse course a little bit as well. So all of that posing a few headwinds, but all is certainly not lost when you look. This is the front month future, of course. We have pulled back below the high that we saw in January at 48.05, but I think it's important to note that we have held so far, and we're holding and bouncing off that level in early trade this afternoon, just after, I should say, the cash open. We have managed to hold on to the 4,700 mark, and I think if that does hold, that is going to be an area that the market looks to buy into. And actually, I think unless there is going to be a significant U-turn from the Fed, they obviously pulled off that sort of dovish pivot in December, unless they decide to undo that, which feels very, very unlikely at this point. I think the market should be relatively content with the path of least resistance continuing to lead higher for now. Of course, we've got a bit of a litmus test this week coming up with the start of earnings season. Some of the major Wall Street banks reporting on Friday before the market open. Also, if you're trading the Dow, United Health, the biggest stock in the Dow by weighting, they report before the market open on Friday as well. So a few hurdles to navigate there. But all the time we remain above the 50-day moving average, which is way below where we are at the moment in the mid 4,500s. I think over the medium term, the market still looks pretty strong to me.
Yeah, I think this one's going to be put to the test this week. As you mentioned, we've got those bank earnings, and I read an FT piece this morning warning about how the bad loans might be picking up on banks' books, and the pressure from these rate hikes, which have largely been by the by in the last couple of quarters in terms of earnings, but how they might just start creeping into commentary in these banks as to whether they're starting to bite on business, on at least certain parts of the business, loans, for example. So it's something to keep an eye at when we get those earnings rolling through. If we do get a spate of softer earnings, then obviously we're going to see stock markets tumbling. But I want to know, is there going to be as much resilience to come in from the dip buyers and hoover that up for a run to the highs, or perhaps not? And again, how stocks reacted on Friday, particularly after the ISM, when those numbers were pretty bad. Stocks finished on the lows, pretty close to the lows. And so, you would have thought bad data would be good for stocks in terms of what the Fed may do regarding easing, but it didn't seem to be the case this time. So there was a bit of divergence there, and I want to watch to see if that continues in the early part of this year, whether bad news for the US economy is now going to be bad news for stocks rather than positive in terms of monetary policy. So, yeah, lots to look forward to this week.
Yes, very much so. And perhaps the most important indicator of them all to tell us what's going on is the 10-year Treasury yield. Yeah,
absolutely. US 10s, we look at them all the time. We speak about following 10-year yields most times on this show, but I think it's especially prevalent to do so this week. Last week, as I said, it felt like the bond market wasn't really back from the holidays until Friday, and then we saw it spark into life. We saw plenty of downside in yields, particularly as the US dollar was sold into the year end. But like US dollar, the yields have bounced also. Now, I'm not expecting too much movement here. Perhaps some consolidation, maybe in a rough 50 basis point zone, as you can see marked on the chart there, between sort of 370 and 420. If that happens, we're likely to see the dollar also consolidating somewhat. If we start moving outside of that zone, though, that's when we'll be seeing some potential larger moves in the dollar and dollar pairs for that. And then maybe we start to see some of these larger ranges tested. So, as usual, let yield be thy guide and how US dollar wants to behave in this early part of the year. But remember that the correlation can be affected by the currency on the other side of any dollar pair. So, bonds, close watching again this week.
Absolutely. The old mantra of if you're not watching tens, you're doing this wrong still stands. Ryan, I'm going to ask you the $1 million question. We're currently trading, I've just pulled it up here, 4.03% is where we trade on the 10-year at the moment on a yield basis. What do we see next, 4.25 or 3.75?
Oh, good question. Good question. I think there's probably scope to see a push up. If the rest of the data isn't going to follow what we saw from the ISM, if inflation holds up on Thursday, then we could get a move up to that area first before we then get a move back down, maybe towards that 375 area, 370 area. So I'm nailing my colours to the mast nice and early, unlike you did for the NFP as usual.
I was in 90 minutes before the print. That's plenty early.
Where do you think it's going in? Where do you think it's going?
No, actually, I genuinely agree with you on that. I do think that we are likely to see Treasuries sell off just a little bit further. But I do think when you get to that kind of 4.25-ish mark on the tens, you're then starting to actually entice people in and entice the buyers to come into the market and lock that in before you look at the Fed beginning a cutting cycle. And I think the same can be said for twos. If you get 25, 30 basis points move higher in yields on the 2-year, again, that's probably going to begin enticing some buyers into the market. So, I think we may see a bit of near-term downside for Treasuries, but overall, you would expect the economy to slow this year. You would also expect the Fed to begin loosening policy, whether it's 3, 4, 5 cuts, whatever. So I think that over the medium term, Treasuries should rally pretty much across the curve.
Yeah, no, I agree with that. And let me throw you another question then. Here we go. Let's get them all out nice and early. What do you think for the Fed? Is it going to be 3 cuts or more?
Oh, blimey. I'm going to put my neck on the line here and say 3 or less.
3 or less. Okay. Yeah.
Go on.
Right, I'll write that down. No, I'll write that down. I don't know. I've been wondering if they can
ask the question. It doesn't know.
Yeah, no, I think if maybe they go two rate cuts.
Well, there we go. We've got it on tape, so we can get Kyriakos to pull those tapes at the end of the year and then laugh about how poorly our predictions have aged.
Exactly.
Right. Let's move on from the Fed, because I want to talk about the Aussie dollar, which was one of last week's worst performers. Not the worst. That was the Japanese yen, which was down over 2.5% on the week and actually had its worst week since all the way back in 2022, if my maths is correct. But it wasn't a particularly great start to 2024 for the Aussie dollar either, which faced what you could describe as a bit of a perfect storm last week. Obviously, it's a higher beta currency, so the shaky risk appetite and downside that we saw in equity certainly not helping. Higher yields, putting a bid into the dollar, that wouldn't have helped much either. And we covered China in quite some depth and the frankly dismal sentiment there towards the world's second largest economy and continued downside that we see in Chinese equities. The FTSE A50, for example, is pretty much at its lowest level since January of 2019. That is certainly not going to be helping the currency particularly much either. So a rather grim fundamental picture for the Aussie dollar, and it doesn't look great technically either, because we're sat right on and we're actually working on a break below as we speak. This trend line, this channel, that's been running the pair higher since mid-November, and we're also very, very close to a break of the 67 figure as well. So I think this is an important one to have on the radar. If we make a closing break below both of those levels, 67.10 and then the 67 figure, certainly opens the door to further downside. You've got those 50 and 200-day moving averages lurking around the 65 figure and then the 66 figure, and then the 100-day and the 65 figure below. In terms of risks to the view, I mean, obviously you could see a bit of a turnaround in China and sentiment there could improve, but we've just covered why that seems unlikely. And the other one is what the RBA are going to do this year. The RBA have switched, just a bit of housekeeping, to meeting 8 times this year rather than the previous 11. God knows why it's taken them to do what everyone else has been doing for so long. Their pricing, though, in terms of OIS and futures, looks about right. 50 bips of cuts is priced for the RBA this year, mostly in the back half of the year. So it doesn't seem like there's much scope for a hawkish repricing there either. So for now, I'm liking the Aussie a little bit lower.
Yeah, and we've got Australian CPI data as well this week, so that needs to be eagerly watched as well.
I'm not sure I'm getting up at midnight to watch it that eagerly, but I agree with your sentiments.
No, definitely not. It's funny how different technical pictures can look, give different outcomes for certain people. I look at this chart, and that last candle you got, that spike low, hit the 38.2, that move up from late November. So in terms of the trend itself, from that bounce, from October, latter part of last year, the trend is still well in play. Hitting that 38.2, bouncing from there. Okay, it hasn't bounced far, but as I say, it keeps the trend in play. So until we break through there and holding below your zones there will be the first step. Getting below 67 and holding below 67 will then see us probably attacking that 38.2 fib again. But if we start to build a bit of a base there, then you've got to think, well, technically it's not looking as bearish as it might be, but that's why I use fibs to gauge the trend. Get through the 38.2, get through the 50 fib, then definitely the trend is starting to change around. But as we said, if there's more easing of tensions between China and Australia, then China start buying a bit more from Australia. That's going to be a bit of a tailwind for the Aussie dollar as well. So I think this pair shows a similar picture to a lot of other dollar pairs, euro dollar, cable, how it's had that move up late last year, and it's held it. We're not breaking back down. So really, until something breaks, I'm afraid the trend is your friend.
Well, you know what they say, mate. It takes 2 to make a market. So we will see how this one turns out. What about Brent?
Yeah, Brent crude. This is the older. Can OPEC keep it up? It's another interesting asset coming into the year. I'm looking at Brent here, and the fact that it's facing yet another period of weakness, and the OPEC bod's trying to keep it supported. I feel that there's good scope to play both sides of this trade. As while global manufacturing remains in a slump, there's good reason to sell rallies because the demand isn't there. But then we've still got that OPEC support, which should keep it afloat in any big dips. We know they're going to be coming out and giving it the jawboning. What I'm looking at here is round down at the 70-71 buck area. That remains key on the technical front, and a place I'll be looking for fairly tight longs. While on the other side, rallies to 87, 88 bucks would be where I'll be looking for shorts. Now, there's a decent enough range to play in both sides of that, and it should give you plenty of time to assess whether any particular news or event is going to help hold or break those levels. So on both areas, one could look at for a break trade. Also, if we break above 88 at 90 bucks, then something has potentially changed. Same on the downside. If we can't hold support down there and we're breaking lower, then maybe something's going on that we haven't heard yet, and you can go with a break trade there. But in the meanwhile, it looks like a good range could be setting up for trading this year.
Yes, very much so. I think crude is an interesting one. I mean, for me, this remains more of a demand story than a supply story. I mean, we still see obviously tensions ongoing in the Middle East, the Red Sea and the Bab el-Mandeb Strait. I've murdered the pronunciation of that, forgive me, are the key sort of flashpoints at the moment and what that's doing in terms of shipping. But any moves higher that we see on a headline that could indicate supply disruptions seems to be sold into pretty rapidly. And that move seems to fade pretty quickly. And I can't quite see from where I'm sat, really need to get my eyes checked, I think, how far back your chart goes here. But there has always been a tendency in the crude market to kind of get overexcitable about potential Middle East related supply disruption and then to focus very quickly back on what matters, which is the demand side of the equation. So for me, I actually still like selling into any rallies that we were to see in crude and in the energy space more broadly. And unless we see demand start to turn around, we do see a decent pickup in manufacturing activity, then I do continue to like both Brent and WTI lower. And I'm not just saying that because we're filming this on a day when WTI is down about 5%.
Well, you give yourself a nice head start anyway.
Exactly. Can we base it on this morning's opening price?
Exactly. Yeah, exactly. Base it on that. But yeah, and another thing that seems to have picked up in various commentary of the last few days is maybe would the Saudis look at doing something that they did before, crunching the price, knocking out all the US shale people over there because they've obviously got quite high production levels, so they could go for a bit of go against themselves by increasing production, slamming the price down, clearing a load of shale people out before then cutting production again and ramping the price up. So even though they want prices higher, you can never rule out them knocking prices down first before they then knock them back up again. So that's one of the sort of big headlines you'd want to look out for. Obviously, be a bit of a range breaker for the downside for oil prices. But it's never a dull moment with these guys in oil markets.
No, certainly not. And I think just a last point on oil is, OPEC's a shambles at the moment. Genuinely, compliance with the cuts is a mess. Angola have left because they want to pump more. I don't think they're the only ones who are going to be considering doing that sort of thing. And then you think back to the December OPEC meeting. They couldn't even agree a date for the damn thing, let alone what they were actually going to decide at the meeting. Sorry, November, forgive me, late November. I don't think OPEC are I don't think they have as much of a stronghold over the market as perhaps they did in days gone by, but certainly a risk that markets need to be aware of. In any case, let's get on to our first plays of the day for 2024. So I've just thought we should have done this as plays of the year, but given that we're about to film the segment, it's a little bit late to throw that curveball out there. So we will do plays of the day instead. And I'm going to look at the euro this week. I think 2024 has started pretty much as 2023 went for the euro, where we get to a key level and then we reverse course back into what is now a very, very familiar range in pretty rapid fashion. And one thing that sprung to mind when I was pulling this chart together this morning is just how quiet euro dollar was last year. We've pretty much gone nowhere and traded in a 105 to 112 range and a handful of pips either side of that for pretty much the entire year, which was almost akin to watching paint dry. In any case, we saw a failed move higher north of 111 towards the tail end of last year. And then obviously we had that move higher in the dollar last week, which applied further downside pressure to the pair. And we couldn't get above 110 into the close on Friday after that very brief dollar selling after the ISM services PMI print. So the thing I'm looking at here is, can this downside extend below the 50 and the 200-day moving averages? They come in at 108.65 and 108.50 respectively. If we do get a decent break below those levels on a closing basis, then this is something that I would be looking to get short, probably targeting the 107 figure initially. So waiting and seeing what happens here, but bearish on the euro in the short term, as is rather typical from my point of view these days.
You bearish? Never. I've never seen you bearish before in my life. Okay, right. Well,
it would be a cry for help if I wasn't, I think.
Yeah, I'd have to get someone to check your temperature if you're ever bullish on the euro. But yeah, I'm going to look at dollar MEX for my play of the day. We're approaching some big, decent support down here in the MEX. Excuse me, got a little tickle in my throat.
A frog in his throat.
Yeah, got a frog in my throat. Not a boiling one like JP Morgan have said this morning, but a normal one. Now, there's been some market commentators who have read a bit more hawkishness into the latest Mexico minutes. That's led to the Mexican peso, remaining quite well bid. That bid brings us quite close to last year's support down at 1671. And given the scale of the move that we've seen from the 1850s, that could potentially mark a decent stall point for that move. So for me, I'm looking to go long into 1670, 71 for a move back to at least 1705 with a stop under the low from last July. So a nice technical trade to kick the year off.
Good stuff. I have absolutely no edge in the Mexican peso whatsoever, so I have nothing to add there. And I think that's a lesson to us all. If you don't understand something, then don't go near it in terms of trading.
Yes.
Exactly that. Right, that does bring us to the end of our first trade-off for the year. Thank you very much, as always, to Ryan Littlestone from Forex Live and Forex Analytics for joining me. Thank you also to Kyriakos for bringing this together as brilliantly as he always does. And thank you, of course, for watching. Hope you've enjoyed the show. If you have, drop a like on the video, leave a comment as well. Let us know how you're trading the markets. And we will be back next week, as with every week this year, to run through all of the fun goings on that we have coming up in this busy week for the financial markets. Thanks again for watching, and goodbye for now.